Hey everyone, welcome to Valuing Stocks. Got an exciting new series of videos that I would like to create for you all. I get a lot of questions from people on Facebook, from family members, from friends who may not be very familiar with the stock market or investing in stocks. And I find that there are often some basic uh, fundamental things that people fail to understand about the stock market. And so my end goal at the end of this series, I don't know how many videos there's going to be, let's say, 4, 5, or 6 different videos, that you will be well versed enough in the stock market world, in investing in stocks, that you can have an intelligent conversation with people at a party or, your colleagues or whatnot when the topic comes up, when somebody says, hey, I'm thinking about investing in XYZ company, then you'll be able to talk intelligently about it. So this first video, as you can see on my screen here, what I'd like to talk about is, what is a share of stock? And embedded in that question is a bunch of things that I think will really help kick off this series. So let me just move that title out of the way and let's get started. So I think the first thing, most of you have a fundamental understanding of business, right? So you've got a company or a business that is, it's designed, the purpose of the business is to either make a product and sell it, or sell a service, right? That's basically what all businesses do, is either sell products or services. And so for the purpose of this video, let's just come up with a very simple business that everyone understands who's ever been a child, at least in America. There are places too, right? So this is the business of the lemonade stand, right? Okay, and so we've got this lemonade stand here where we sell, this is my little pitcher of lemonade. As you will soon find out, I am not an artist. I'm sure you would gather that yourself. So we've got a lemonade stand where we sell lemonade, right? And let's say that we sell our glasses of lemonade for $1, right? So I'm just gonna put that lemonade stand over, whoops, in the corner, if I can get this to go. All right. So we got a business that we want to start, selling lemonade to thirsty neighborhood people, right? And let's say for the stand, the cups, the pitcher, the water, the sugar, the lemonade flavoring, it's going to cost you $100 to start up this business. So in any business, you've got two potential sources of funding, right? You can either borrow the money to start it. So if we need $100, that's called debt, right? So we could borrow the $100, or I'll use green again. This thing called equity, right? So we could just find $100 in our savings account, put it towards this business. It's our own money, or we could get some investors, right? Let's say we find 5 investors and they pony up, $20 a piece, right? 20, 20, 20, 20. That's 100, right? Or maybe you have 4. Let's erase this one. Maybe you have 4 and then you put in the 20 yourself, right? So I can erase that. Okay. So this collectively is your $100. Now, those are your two choices. But you can do a mix, right? Let's say you wanted to borrow $40. Maybe you're borrowing it from your mom or your dad. They would be your lenders, your debt holders. And let's say you put up 60 of your own, right? So you could do a combination of debt and equity, or probably wouldn't do 100% debt because then you really have no ownership in the. Well, no, that's not true. But it would be very risky, right? So kind of all of the assets would be. All right, let's scratch that. Let's not go down that road. So we got our lemonade stand. And in this case, to make things easy, we'll talk about debt later, but for now, let's not talk about debt. So let's say you've got, okay, sorry, I was interrupted by a phone call, but now I am back. So let's say you've got four investors. Let's change this to 4. All right. We'll get better at this as we go along. So you have 4 investors, plus this is you, right? Right here. That's 20. So 5 people total. You own 1/5 of the company. 4 other people, maybe your friends, put up $20 each, and also own 1/5 of the business, right? So you get your $100. You set up your lemonade stand, and you start selling, right? Now let's say your first year, let's say you're seasonal, you're only open in the summer. So let's look at some numbers, and I'm going to change colors because we're using a lot of green. So let's say you bring in $200. All right. Actually, before that though, we're trying to answer the question: what is a stock? All right. Okay. Back up the truck here. So let's go back to green. So your $100. Let's lay this out here. So the equity of your business, because you have no debt, is the $100 you put in, right? You went ahead and you spent that $100 to buy some assets, a lemonade stand, the cups, the pitch, for $100. So you have $100 worth of assets in this ideal world. And so you each own, now the cash is no longer here, but now you each have a claim to 1/5 the assets as the shareholders. So you and your friends, right? And let's say you created a corporation, and you issue shares of stock. That just means if you have stockholders, you're a corporation, which most publicly traded companies are. There's different types of entities, LLCs, corporations. We're talking about corporations, okay? Corporations will issue shares, right? So the company, lemonade stand company, issues shares of stock to the 5 shareholders, right? But let's say they want to issue 100 shares at $1. Looks like an arrow. $1 each. Okay? So if there's 5 of you, how many shares do you get issued when you put up your money, when your friends invested their money? You gave them each 20 shares, right? And then you over here put up your own money and retain 20 shares. All right. Now, each share is worth $1 initially, and that dollar you can see is backed by this $100 in assets here, right? Now, what that means is if you have your business, it's like a pie, right? And you're dividing the ownership up, right, into all these little slices. So you just divide it up into like 100 slices because you said 100 shares. And you're giving 20 slices of the pie let's say give this portion over here to one shareholder. And we have 5 pieces of the pie. All right? Can't really see that very well. All right, just want to make it clear. That's where you're getting. Your share of stock is an ownership interest in the underlying company. So you are owning part of the company. So, for example, I own shares of Disney, which was very good, a few weeks. I own shares of Disney through my retirement account. That means I am part owner of Disney. So my wife drives her crazy when, I see something that's Disney related or Marvels or Avengers and Star Wars, and I say, hey, we own a piece of this business. This is our company. Because truly, technically, yes, it is. Like we own maybe a very small portion, but we own a portion of that business. All right, so back to what I was getting at earlier. So let's say in the first year that you you sold 200 glasses of lemonade at $1 each, right? So you brought in $200 of revenue the first year, all right? And a lot of your, let's just make this simplistic, that $100 that you put towards the lemonade stand and supplies and all that junk, let's say that was pretty much enough to supply the lemonade needs for this whole year, right? So you didn't need to buy any more lemonade mix or sugar ups, right? And then the lemonade stand's like a one-time thing, right? That's what we call a capital expenditure, something that lasts for more than a year. But we won't get into it. Okay? All right. Well, so let's say, yeah, so you had some expenses of the supplies from that money you brought up, the sugar, right? So let's just say this is your supplies. And you also had some labor expense. Let's say you pay your little brother or sister, and so they got $25 for all the labor, and they supplied all the labor to sell the drinks throughout the year. So that's labor. So these are all expenses, all right? What's that? We're at $75. And let's say, all right, I'm backing up, back up. All right. So let's say it's $25 for the supplies, not 50, okay? 25 for labor. Say the lemonade stand cost you $50, right? And I'm going to put that over here because this is for the stand, okay? The reason I'm putting it over there is because that's a capital expenditure, CapEx. That means this is an expense, a type of expense where you buy something that's like equipment or land, something that lasts more than 1 year. And assuming your stand is a sturdy wooden stand that's going to last you for several years. So let's say the useful life of this stand, it's not the best stand, is 2 years, okay? So even though you're spending $50 of cash now, how accounting works and whatnot, you can depreciate your capital expenditure. So your capital assets that you buy, like the stand, you don't just expense it completely, that whole $50 in that year. Since it has a useful life of 2 years, that means for this first year, we're going to subtract out $25 for the stand, okay? And this is in the form of depreciation. So the stand is depreciating by half each year. So okay? And then let's say, so these two are normal expenses. This is a capital expense, but we're depreciating it, right? And let's say we spend another $25 on advertising, which is this is also a normal expense, right? This is expensive. So in the end, after all your expenses and the depreciation expense, which is the translation of this CapEx, then you've got $100. Oops. All right. Get $100 in, we call this operating profit. Okay? And then it's hard to read my handwriting. So you got $100 in operating profit. And for the purposes of this exercise, we're going to assume you have zero taxes. Maybe you're a minor, so you don't pay taxes, right? Zero tax. And you don't have any debt, so you've got zero interest expense. But for a lot of businesses, this would not be zero, right? Most businesses, it's not going to be zero. You can be sure of that. And so really, your bottom line here is what we call net income. When you gotta, this is really like, you might see this term called before interest and taxes, EBIT. That's pretty synonymous with operating profit. So, but net income is when you take into account taxes and interest expense, but here we don't. So our net income is $100 as well in this case, this hypothetical case, right? Now remember, we have 100 shares, right? So if we want to know the earnings per share, which is called EPS, we take $100 of net income divided by the 100 shares. That's $1. $1 of earnings per share, right? So that's a pretty dang good investment because remember, your friends and yourself basically paid $1 per share to buy your interest in this business. After the first year, this business made $1 per share in profit, right? And so your shares are earning basically what you paid for them in 1 year, which is pretty unheard of. So if you have 20 shares, that means your claim on the company's profits is $20 of profit. Pretty good. You put in 20, you get 20 this year, right? Anyway, I think this is a good stopping point. If you've enjoyed this video, please hit the like button and subscribe, and we will have some new videos for you teaching you about the stock market, teaching you about stocks and investing soon.